And I think, one of the most important points on it is you're not just protecting yourself from outside unsecured creditors. And, the best example of that is your kid's driving your car. He's 17. He crashes your car. He
Yeah.
shouldn't have been in the car. He was drinking. And this is a specific example, by the way. He was in the car. He was drinking. That car's crashed. You're liable for that damage because you should have kept that car under control. You didn't. The kid's 17. You're responsible for that child's acts. It goes over the limit on the insurance. How are you going to pay that out of your own pocket? Well, if you're in a trust, that trust is not going to be liable for those debts. So I always look at it as that, you have the external threats, that would be an external threat coming in, but you have the internal threats, bad marriages, drug and alcohol abuse, the things that almost every family experiences these days. You've got to be able to protect from that as well. And that's what these trusts do.
Welcome to the Getting the Deal Done podcast. I'm John Martinka. My special guest today is Mark Pierce with Wyoming Trust Attorney, or wyomingtrustattorney.com if you want to reach out to him. He is in Wyoming. He works nationally, and we're going to have what I'm looking forward to as a discussion on how to protect. We talk a lot about on my podcast and others and in articles about building and creating. Now we're going to talk about how do you keep it. So, welcome, Mark.
Thank you for having me on, John. I appreciate the invitation.
Why don't we start with you telling us a little bit about how you got to be the Wyoming Trust Attorney and again helping people nationally.
Mhm.
Uh, and then maybe what are the few things that we want the audience to get out of this show, and we'll dive into the details on those.
Yeah, great. Thank you. Uh, my family came into the Montana, Wyoming area back in the late 1800s, and they were drilling for oil and gas, and they had the ups and downs of the economies over the last 120 years. And I was intimately involved with my family as they made and lost monies. And I came to the determination pretty early in life that what I would really like to do is to prevent people from losing their money so that they could perpetuate their business and their families on into the future. And you've been out in the West long enough, it's a boom to bust cycle. And you can call the financial collapse that we had in 2018, the COVID crisis, the banking collapse in 1980. It's not just about making it, it's also about keeping it. So I decided that I was going to dedicate myself to ascertaining a way in which to allow families to perpetuate themselves in good times and bad times. So I became a CPA. I practiced as a CPA for a while, and then I went to law school, developed a tax expertise, and got out into the community and began doing trust work.
Okay. So what are the top few things we're going to talk about before we get into those details?
Well, I think the most important thing is to understand what it is that you want to accomplish as a family. And as a family, there are internal and external risks. I know that within my own family, we have had over the generations problems with addiction and alcohol abuse, marriage and divorces, that sort of thing, extraneous behavior, people behaving in an ill-adept, ill-informed way, if you will, the wayward son, that sort of thing. But it's also about protecting yourself from the external threats, the ups and downs of the economy. So those are the things that I began focusing on. And in Wyoming, several years ago, there was something established called the Wyoming State Political Action Committee, which got together with the legislators and had several of the large banks involved, where we went through and we completely reorganized our LLC statutes to provide for the most asset protective structure in the United States in the form of a limited liability company. For instance, Wyoming, with a single member LLC, recognizes the efficacy of that LLC and then only allows a creditor a charging order against the membership interest so that they can't disband the LLC. Second thing that the legislature did is they implemented I think, the most robust asset protection trust statutes in the United States. For instance, you transfer assets into an asset protection trust, you have a 4-month statute of limitations if you meet certain statutory requirements. Most other states have 2 and 4 year statute of limitations on the transfer of those assets into the trust that allow the creditors to pull those assets out. Wyoming's 4 months. That's just by way of example, but those are the two major things that Wyoming has done.
Okay. So what are your typical scenarios of a client for you? Is it, we work with people selling their business and, is it stock gains? Is it, real estate gains? What is it?
Well, essentially, what we're trying to do is provide an umbrella that allows a family to exist in the standpoint of the perpetuation of their businesses and their money with the most tax advised, tax beneficial way to do that in terms of estate taxation, income taxation, that sort of thing. We want to do that, but we also want to protect those assets from failed marriages, bad debts, that sort of thing as well. So that's been our real focus, and I think that's what differentiates us from a lot of other people is that we're looking at internal and external. So we work with a family together, particularly if they're anticipating having a sale. If you're going to have a sale, you're going to have a lot of money laying around. You're going to sit around, you're going to say, what are we going to do with that money? Well, you'll find good people out there who can really provide a benefit to you in investing and managing that money. But you need to have people who are qualified to give you good tax advice, who are qualified to give you in the event that you have a child that is in a marriage and the marriage is failing, give you good advice on that sort of thing, how to exclude that divorcing spouse outside of the family, away from family assets, things such as that, because those are the things that come back and haunt you.
Okay. So, you do you work with, is it primarily on the individual side versus the business owner side?
Well, a little bit of both because it's hard to differentiate the individual from the business a lot of times. So what we do is we put a structure in place, typically a limited liability company. We put the owner in charge of that limited liability company because it's their company. And then we talk to them about if something were to happen to you, what do you want to see happen to this business? Do you have somebody in the family you would like to see take it over? Do you want a consortium of individuals with your family to do that? How are your kids doing? Are the kids having any drug, alcohol abuse problems? Are they engaged in good marriages? Are they engaged in poor marriages? How do you protect and structure away from that? And then you put together the more complex issues within the umbrella under the trust itself, like management services organizations and reducing the exposure to liabilities, moving assets over into exempt assets. For instance, a lot of people are buying insurance annuities these days because they're exempt from execution by any creditor. So that's the type of advice that we give.
Okay. Uh, so what is the minimal amount of assets someone needs to make this viable?
I think if you're retiring about 2 million, I think that if you're involved in businesses that are growing, it's about 2 to 5 million.
Okay. So I'm in Washington State. Washington State recently a few years ago, put in what probably is illegal, but it's standing a capital gains tax that is now up to 9.9% on any gain over 250,000. They just put in for in a couple years from now, a millionaire's tax, they call it. Anything income over 1 million gets taxed at about 10%. Uh, Highest estate tax in the country. If someone can't, what would someone do if they said, I want to be avoiding that and using your services?
Okay, there's a very interesting case out there involving a California individual who was a beneficiary of a trust, and she had inherited that trust. She came into that trust when her father died. He'd been a very wealthy oil and gas individual. She got married. She had a couple kids. She got divorced. Her husband ends up with the kids. So they take that trust and they decant it to South Dakota. South Dakota does not recognize child support or alimony claims from an outside jurisdiction. So what happened is the state of California came in and said, hey, wait a minute. We have a judgment for alimony and child support. We're going to enforce that judgment against the South Dakota trust. South Dakota Supreme Court came in and said, under the United States Constitution, we have to give efficacy under the full faith and credit clause to your judgment. So we'll do that. We'll recognize the judgment. However, the collection mechanisms are governed by the individual state law, and that goes back to the IRS, that goes back to federal law. So that's well imbued within our collection system. It's not something that South Dakota came up with. So they said, and as a result of that, you cannot attach these assets on that trust. So what happened is you have to distinguish between movable assets and non-movable assets. Non-movable assets would be things like businesses, houses, rental properties, things like that. If you've got an apartment building in Washington, that court's going to have jurisdiction on that. If you take movable assets such as cash, stock accounts, intellectual property, that sort of thing, and you move it into an LLC and you domicile it in Wyoming and you put it into that trust, then the individual who does that does not have a property interest. The state of Washington would not have anything to attach on that individual because under Wyoming law, that individual doesn't have a property interest. So if they got a judgment against that individual and came to Wyoming and tried to collect it, Wyoming would say, we recognize the judgment. However, you have no ability to enforce it against the assets are in Wyoming. So the stock and all of that would be outside of that individual's estate. So then you come in and you say, okay, what about the taxes that pertain to that? And you say, well, we structure it as a non-grantor revocable trust. That means it's domiciled in Wyoming. Wyoming trusts do not owe state income tax to Washington, nor do they owe capital gains tax or estate taxes or anything such as that. So that's where the real battle lines have been drawn up, and that's what we began doing.
Okay. Are you seeing much activity as these wet states along the coast start increasing all these
Uh,
taxes?
Yes, and what I've done is that I've had a series of doctors who have come to me that operate, for instance, they have a lot of referrals based on surgeries. They're surgical doctors. And what they'll do is they organize an LLC that's owned by a trust in Wyoming, and that entity books the surgery and takes a commission for booking that surgery. And then the surgical LLC that's located in whatever state that they're in on the East Coast generally, nobody from the West Coast has done it yet, but the East Coast generally, then will recognize the income that comes through that surgery so they can pay all their costs and expenses and their living expenses. But they accumulate their wealth in that trust in Wyoming through those booking licenses.
Wow, that's pretty interesting.
Yes, it is.
Okay, so we've got are there other things besides the trust that that you get involved with that help people?
Yes, we do quite a lot of limited liability company work, and we do some structured planning involving management service organizations, which have just become under scrutiny with the Internal Revenue Service because people have been abusing them. You establish what they call an MSO, a management service organization, that essentially operates as a family office.
Yep.
And the family office runs all the LLCs or corporations that the family has. You're able to establish a pension fund in there, so you get a full deductibility for contributions and matching contributions on the pension fund. You run a certain amount of earned and unearned income through that, staying with the ambit and limitations on the Social Security Act. And you enhance your ability to finance within those companies, and you enhance your abilities to manage them through professional service organizations. So we provide that as well.
Okay.
And,
So
and that
one of the
savings.
things I'm a little bit familiar with and is someone selling a business or a piece of real estate or just has a big capital gains coming up, they can they can put it into a trust and defer all their taxes on it.
Hmm.
You're not familiar with that?
No, I wonder how they're proposing to do that. Essentially, you can do a 1031 exchange. Is that what you're looking at?
No, I'm getting in over my area of expertise, but we do know a company that does that, and I don't know if it falls into the installment sale world or what, but if they sell their business for $10 million dollars and they don't need $10 million dollars, they can put it into a special trust
Uh,
and it gets taxed when they pull it out.
Yeah, so one of the things that we've done all the time over time that helps dissipate the estate and perpetuate the postponement of taxes is an intentionally defective grantor trust that buys the business from a grantor, pays the grantor the money from that business over a long period of time, and that results in some fairly good tax savings that occur from that as well. But then you've got double exclusion on the state tax exemption part and the trust part with the grant to the settler of the trust. Pretty complex structure, but I'm not aware of it putting something into a trust and it automatically deferring the
Yeah.
gain.
I don't think it automatically does. It has to be set up correctly and you can manage the money, but I guess maybe I shouldn't have opened up that subject, but it is out there.
That'd be,
Do you do much with charitable stuff?
We do some. Typically, when it comes down to the charitable work, I refer it over to an attorney who knows a lot more about charitable work than I do and how to structure and put those things together.
Okay.
The art, it, as my, I've looked a lot at this, but I don't practice in that area. But I can tell you that the differentiating aspect is putting yourself into the right trust to begin with so that you can maintain that trust, maintain that charitable trust over a long period of time and not run afoul of the rules regarding the administration of that trust. And you really need to get a group of accountants who can assist you with that. So I recommend a group who does that sort of thing, and they do it, fairly quickly and efficiently. But you have to make sure that you comply with the rules with that. There have been, from my understanding, the IRS is looking very heavily at some of these 501(c)(3)s that people have put together that manage to have 5 million in revenue, 5 million in expenses, and never make a charitable contribution. So you kind of are getting to the point where some people have been abusing that. So it's like the 83 A's and B's out of Puerto Rico on the management service organizations. So many people jumped into because it was such a good idea that I think, there's been a couple bad apples that are going to ruin it for everyone. So you're beginning to see some audits on
Yeah.
that.
Now, Mark, do you get involved much with preserving things from estate taxes?
Yes, absolutely. The non-grantor trust is what we structured. I took $100 million estate with a $20 million exemption and got them down to almost nothing in estate taxation. So typically what they would have gotten is they would have had 80 million in tax, 80 million in taxes at a 40% rate, $32 million. We got it down to zero based on valuation indexes. So that's what I've been able to do several times with people over the years.
Okay. So if we look at your general services of protecting what you have and a couple scenarios. One is say, let's take your middle American family and between their house and their 401(k) and their investments and et cetera, they're worth $5 or so million. And uh, is it worth for them to be working with someone like you?
Oh yeah, absolutely. I think from that standpoint, you can put a trust together that allows for not so much, at that level, typically with your house, it's probably exempt from creditors because of the homestead exemption, depending on the state that you live in. Your 401(k), your IRA, whatever you got, is probably also exempt from
Yeah.
execution. But you've also got, let's say you got $5 million in cash assets. Well, that's fine. So, you're in that trust and you put yourself into a trust or some sort of estate planning mechanism with your wife, and you die or she dies, and then you remarry or she remarries. What keeps that individual, that second marriage, from getting into that pocket of $5 million? Because, the divorce statutes would say that there is an interest of some sort at some point in time with that. So the other factor is, let's say that you have a husband and wife, you both die, it goes out to the kids. What happens if the kids are not having good marriages? What happens if those kids get the money out of the estate and then they're divorced from their spouse gets half of it? Or because what ends up happening is that inheritances are exempt from execution by that child's spouse, but they always commingle the funds in a joint bank account, or they buy houses together, or they get condos together, and then they have kids. So the money just ends up in a giant pot, and she ends up with half of it even though she was outside of the family. She's not part of the family once the divorce is over. So I think that these trusts are the most effective prenuptial agreement you can have for your kids. And I had a client who had a $20 million estate. His son, they wanted to make sure they were doing some estate planning. So his son got a $5 million grant out of that estate based on the value of real estate and whatnot. Married a young lady, didn't get a prenup. Not that they're all that enforceable to begin with. They were married for, I think, 2 or 3 years. She sued him for divorce. She walked away with about $1.5 million out of that. And that was the settlement. And that could have been avoided with an asset protection trust.
Okay. So I'm hearing for you that an asset protection trust can be for almost anyone that has a decent amount of assets, from
Yeah,
middle America on up.
yes. And I think, one of the most important points on it is you're not just protecting yourself from outside unsecured creditors. And, the best example of that is your kid's driving your car. He's 17. He crashes your car. He
Yeah.
shouldn't have been in the car. He was drinking. And this is a specific example, by the way. He was in the car, he was drinking. That car's crashed. You're liable for that damage because you should have kept that car under control. You didn't. The kid's 17. You're responsible for that child's acts. It goes over the limit on the insurance. How are you going to pay that out of your own pocket? Well, if you're in a trust, that trust is not going to be liable for those debts. So I always look at it as that, you have the external threats, that would be an external threat coming in, but you have the internal threats, bad marriages, drug and alcohol abuse, the things that almost every family experiences these days. You've got to be able to protect from that as well. And that's what these trusts do.
Okay. So if I think I'm getting an understanding of this, Mark. It's a new subject for me, and it's very interesting. Uh, so what about when you talked about your doctors? So what's a doctor or business owner, even a high paid executive, could put things into a trust in Wyoming. Does does that shield them from federal income tax?
No,
No.
you're going to have to pay your federal income tax,
And
but
as a trust.
as a trust, but you don't get double taxation. If let's say that you've got $1 million, you make $1 million one year, the trust pays the tax on that $1 million and then distributes the net out to the doctor or to whomever established the trust. That distribution doesn't result in a second tax. It's not a corporation.
It's after
Yeah.
tax.
Yep, it's all after tax.
Okay. Interesting.
Yeah.
Very interesting. So who's finish up here with who are your most common clients? You mentioned doctors. Is it professionals, business owners, just family wealth, all of the above?
Yeah, it's almost all above. I get a lot of doctors, and I get a couple of attorneys who have come in and got my advice and had asset protection trusts. Um, Insurance salesmen have come in and done that. People who've gone through more than one divorce, they come in, they get a lot of trusts as well. They're starting to do some planning, and mostly what I prefer to work with are professionals and business owners. I find that to be the most interesting.
Okay. All right. So this has been a fascinating discussion. Went a couple directions I didn't anticipate, but it was good education. You're in Wyoming. What do you like to do when you're not doing trusts?
I play the piano and fish.
Okay. Fly fishing?
Yeah, I try to fly fish.
Try to fly fish.
I've been at it for 65 years. I'm still learning.
Yeah. Well, I see the exercycle behind you, so
Oh yeah, I've got to, when you start getting up to the higher elevations, you've got to have some oxygen carrying capacity.
right.
Yeah,
And how is the fishing in Wyoming these days?
it's been a little rough. We had a really severe drought over the last year or two, part of like about a 10-year drought, and the impact on the fisheries has been pretty substantial, particularly in the lower elevations.
Oh,
Yeah, and this year we had no moisture, so I don't know what it's going to be like.
yeah, that's too bad. It's
Yeah, well, that's the excuse that I'm using for when I don't come home with anything.
yeah. Well, is it mostly catch and release?
Yeah, I won't catch and release anyway.
Yeah.
Yeah, I
Okay.
just don't. It's not something I just, whatever. I think it's necessary because with the number of people who've gotten into the sport, you can't have people taking the fish whole and eat them because you're not going to have any fish left by the end of the
Right.
summer. Yeah.
Okay.
And I like the idea of having a repairing environment that allows fish to propagate and have a healthy fishery. So,
That's right.
yeah.
Great. Well, Mark,
Yeah.
thank you for being on. Again, it's Mark Pierce, WyomingTrustAttorney.com. And as you've heard, he works nationally and he can help just about anybody that has assets to protect and from a variety of circumstances. And that applies to, business owners like we work with, to the professionals and executives and people going through a change in life. So, Mark, thank you for being on the Getting the Deal Done podcast.
Hey, well, thank you, John. I appreciate
Okay.
the invitation.
I, I wish you all the best.
Thank you.